Hello everyone, welcome to my channel. Today we are going to discuss about ETFs, mutual funds and stocks. What are you going to choose? How are you going to choose? And when to invest in ETFs, when to invest in mutual funds, when to invest in direct stocks. In this video, we are also going to discuss about comparing ETF and mutual funds with stock investing, and we will discuss about what are the problems when you invest directly into the stocks. I am not a SEBI registered research analyst. This video is not a buy or sell recommendation. Consult your financial advisor before taking any risk into the stock market. ETF and mutual funds are a basket of securities. You are just owning a fraction of this basket, hence your diversification is taken care of. While you are owning a stock, you are actually owning an individual company, and the investor has to take care of the diversification by themselves. On taxation front, no tax is levied on an investor when the AMC of the mutual fund rebalances their portfolio. Tax is only levied on the investor of the mutual fund when they decide to exit. While in stocks, when an individual investor decides to sell their holding in a stock, they have to pay capital gains taxes. ETFs and stocks are actively traded on the National Stock Exchange, whereas mutual funds are traded through fund houses, and their daily market price is decided when the markets are closed. Basically, their NAV is decided when the market are closed. There is a risk of delisting when it comes to liquidity of stocks. Let's discuss management and fees. So as we know, ETFs are actually tracking an index. So they are mostly a passive investment product, hence having a lower expense ratio. But when it comes to mutual funds can be actively or passively managed by the AMCs. Hence, they have an expense ratio which is higher. For owning stocks, investors have to pay brokerage charges to the broker. Now let's consider investment minimums. How much minimum we can invest in each of these instruments? For ETF, you have to buy minimum of 1 unit of ETF from exchange at traded price. Whereas for mutual funds, they also support a fractional ownership of your investment. If you have 500 rupees, then they can support you by letting you own fractional shares, fractional units of mutual fund units, which is actually an advantage. Minimum investment in a company is actually 1 share of that company, price of that 1 share of the company. For ETFs, no dividend will be distributed to the investors of ETF. For mutual funds, there are options available for dividend distribution. You can choose a non-dividend paying mutual fund, which is a growth mutual fund, or you can choose a dividend paying mutual fund. For stocks, when you are owning a stock, it totally depends upon the company whether they want to distribute dividends to their investors or not. Here are a list of high valued multinational companies whose value of share is very high. Now, minimum ticket size to invest these shares is, you can see, 20,000 or more. But you can invest in it through mutual funds or ETFs for them. Let's discuss problems associated with investing in direct stocks. Do you have large ticket size? Are you disciplined enough to enter at the price you are desiring to enter in the stock? Are you having the ability to pick right investment and ride the momentum? If yes, then you can indulge in direct stock investing. However, the challenges in doing so are sector can perform but not your company. There is a very high possibility of that. There may be a chance that you are holding a good company as an investment, still its stock price does not perform. And third and most important, timing the market is not as easy as you think. We can take example of Bank Nifty versus HDFC Bank. Bank Nifty gave decent returns in past 3 years to 5 years, whereas HDFC Bank hasn't given that much return as Bank Nifty in the past 3 years. And mind it, HDFC Bank is not a bad company. Still, its stock price hasn't performed since past 3 to 5 years. Now let us talk about why timing is not easy in the markets. Let's consider ITC stock. Is it a bad company? I don't think so. On hindsight, you would have thought that in 2020 I would have invested at 120 levels and get a return of 300% by selling it at around 360 to 440 levels. But let us look at the difficulties. In 2020, when the stock was at 120 levels, everyone was actually bearish on ITC and nobody ever dreamt or ever thought of buying ITC at that price. Suppose in your wildest dreams you managed to buy ITC at 120 levels. Clap for you. But you would have ended up selling it at all-time high levels during that time, thinking that how far will it go from that levels. Now what actually happens? What actually happens is that you ended up buying in a FOMO at 290 to 300 levels, thinking that this is now a very good company and I will make really good returns. But what happens next? You are still there with 0% return. After 3 years, in 2026, the stock price is still 300. And if you are unlucky enough, then you, my friend genius, you will have bought it at the top, which most of you have bought at top, and you will still be sitting at a 35% loss at a buy price of 300 rupees. Now we will have a question that where to use the ETFs. Consider if you want to invest in an index such as Nifty, or you want to invest in a sector which you are betting on such as auto or pharma. At that time, you can invest through the ETFs of the sector or indices. Nowadays, we also have some strategic indices such as Nifty Alpha 50 that are being published by NSE based on their quantitative strategies. You can also invest in these indices through your ETFs. Few years ago, investing in gold and silver for long term was not possible without going for physical delivery of gold and silver. But now, as a retail investor, you can invest through ETFs for long term. A retail investor can also invest in international markets through ETFs of international indices such as Nasdaq and Hang Seng. On NSE India website, you can find the list of ETFs available. If as an investor you want a regular dividends from your investments, or you want a tax-free rebalancing of your investment portfolio that includes both debt and equity, then you will choose mutual funds for investments. Unlike fixed deposits that incurs taxes on interest income as well as when it gets mature, debt funds are tax efficient and they tax you only when you are going to sell your debt funds. Investing in direct stocks are better if you are really good at identifying right stock and you are good in riding the momentum. ETFs are good for long-term investing if you want to invest in any sector specifically or in any index of Indian stock markets, in any commodities like gold and silver, or you want to invest in international markets. If you want to invest in mutual funds, then know firstly that they are tax efficient blend of debt and equity, and they also provide you with dividend income. So it is good for new retail investors to stick to ETFs and mutual funds to consider their investing. Subscribe to my channel. Please like and share my content. If you liked it, do give me a feedback in the comment section. Thank you.